Hi, everyone, and welcome to a fresh new episode of our Made for YouTube series. I am Sumaira Abidi, and today we're going to be talking about the growing interest in using the fund of funds as a vehicle for overseas investing. Joining me is Ashwin Patni, who's the head of products and alternatives at Axis Mutual Fund. Ashwin, thanks very much for joining in. So, we have spoken at length about why overseas investing. So we want to take it a step further today and talk about which is the best way to do it, right? The premise, of course, being that, overseas diversification is a plus for a portfolio. So therefore, now, how do you do it best? I've been seeing a lot of fund of funds being launched. Is that the most optimum way to go about it?
Yeah. Hi, Sumaira. So basically, I think the reason fund of funds are launched is because they allow you to access ready-made funds which are available already, being managed, already being run by global asset managers in the global domain, which you can readily tap into. And that's the advantage that fund of funds bring in. So from day one itself, even though these funds could be new in India, but from day one itself, there is a certain amount of portfolio track record, positioning information, which is already in place because the underlying funds have been around for a while in the global domain, as I said. And that's really the biggest advantage because it's a ready-made package, so to speak. The performance, the track record, the positioning is all well known. It allows partners, investors to clearly understand what the fund has been able to do over a period of time, what the portfolio is like, what the positioning is like. And in that sense, it makes it very easy in an otherwise slightly complex space like global investing, which is, as we've been discussing over the last year or so. It's relatively new while it's gaining popularity, but it's a vast space. It's not an easy space even for specialists to get their head around. And therefore, as investors, being able to analyze an existing fund always makes it relatively easier for them to take a call on whether to invest or not to invest, and which is what fund of funds are able to do.
Okay, so the big advantage, therefore, is the fact that it's not treated like a new fund offer where everything is new. Basically, the track record of the underlying funds becomes the track record collectively, therefore, of this, which is the fund of funds. But they're more expensive than ETF. So does the one advantage of having a track record score over the costs and ultimately returns?
So I think there is no one answer for this because while fund of funds also the expense ratios doesn't have to be uniformly either high or low. For example, I can tell you that when we have done fund of funds, we've been very sensitive on a total cost to investor, and it's been our understanding and belief that if you look at the funds we offer, the total cost to investors is in line with any other active managed product. But having said that, obviously, between an active product and a passive product, there will be pricing differences. So ultimately, I think what works for which segment is something that people have to decide. Let me give you a simple example. For a relatively maybe efficient market like the US, an index fund may find it easier to give you the exposure. Whereas for something which is slightly less evolved, let's say a China, an index fund may not be able to give you the same exposure, just like we've seen in a market like India as well. So I think it's not just about the expense ratio. You also have to look at the segment that these products are investing. The second related point is that, especially when it comes to more complex pan global kind of strategies, it's more difficult to execute an index type strategy because it's very difficult to have passive products that can allocate all over the world. Just the basket, etc., becomes very, very large.
Okay.
And that's where perhaps again an active manager can play a role. Just talking from experience of our own range, where we've done a couple of global products, it is much easier when there is an active manager who can take those calls in terms of across countries, taking deciding how to sort of make allocations and where this makes sense. And ultimately, the proof of the pudding is in the track record. By doing all this, if they have been able to generate alpha, then it obviously makes sense for investors to do that. So yes, I would say there is space for both of these strategies to coexist, and it's very important that investors use them in their correct manner.
Ashwin, is there any variety of fund, like geography focused or theme focused or some such, where fund of funds is better over other passive routes, or is it across the board?
I feel, continuing from my previous point, I feel that fund of funds work very well, and here we are specifically talking about fund of active funds, where
Yes.
the underlying funds are actively managed. So actively managed strategies work well when there are slight complexities or inefficiencies in the market, which an active manager can exploit, or where there is a value addition that an active manager can bring to the table. Another example of that is the whole sort of the new age innovation space that I can talk about. Now, that is an area where obviously there are a number of passive products, but it's a very fast moving space. We expect investors to allocate with a 3, 5, 10-year view. Then the challenge that they will have is that the theme that they may put today on a passive basis, just to take one example, fintech or EV, may or may not remain relevant, over 5 years or 7 years. And that's where an active managed product can really make a difference, because as the themes evolve, the fund manager is able to take those calls of migrating the product and the portfolio positioning appropriately. And that's where we felt that the theme, like an innovation, for example, or disruption, for example, an active manager has a lot of room to play. The second example, which we already discussed, is if you're investing in a region which is not known for a very high level of market efficiency. Look at the emerging markets, or specifically the example of China, which I gave a little earlier. Some of these places, the markets are not that efficient, and there is room for active managers to add value. So again, if I will look at these two examples, I think there is scope for active managers. Contrast that with, we spoke about the US market. Perhaps an S&P 500 or whatever gives you a reasonably good way to access that market. So I think that's really the balance that that investors need to draw when they look at these products.
Actually, the other point is that, if you look at the biggest market, which is US, and you alluded to it also, I was reading some data that over the last 10 years, only 12% of active managers have managed to beat their benchmark. Therefore, while I take the point that, there is scope for active management in a lot of areas, does it not become a worry for fund of fund investors? Because, suppose there are five underlying funds, out of that, only one or two may perform.
Absolutely, and I think that's a very fair concern to have, which is where I think you will find that the broad-based, diversified strategies will be fewer, and you will probably see them getting replaced by passive, especially places like the US. At the same time, what we are also seeing, just talking about the market trends, is that if you look at investors today, if you look at advisors today, a lot of interest is actually less in allocating money to broad-based general strategies, as opposed to taking views on specific themes which are developing. And I think these really work well because they allow you to also take a little bit of a view on how these things are evolving. And also, because Indian investors, we already have exposure to a certain set of themes within the local market, and you can pick and choose complementary themes from the global side. So disruption innovation is a great example. So I would say broad-based ones, yes, the concern is fair. Like I said, in a narrow, a single country US market, passives can work pretty well. But if you're talking about a theme, that to a fast evolving theme where the scenario is changing, I think there is still a lot of room for a manager to add value. And even in those markets locally, we have seen that active funds have been the order of the day, especially when it comes to looking at these kind of themes.
Okay, one final question, Ashwin. How is the selection of the underlying funds done? Is it that AMCs will choose their global partner, or an international AMC with whom they have had a relationship, and therefore all the underlying funds come from that one particular AMC, or is there scope for diversification on that level as well?
No, I think the most important thing is that ultimately we are answerable to our investors here. So when we bring a product, there is has to be a level of comfort and confidence that investors have. That, for example, in our case, if I talk about Access, that they believe that Axis has done the due diligence and Axis has done the required amount of check before bringing that product to the market, and we take that very seriously. I'm sure all our peers do as well. So while for ease and for strategic reasons, it's always easier to work with a partner. What that does not mean is that you don't really sort of blindly bring in products which are doing well. There is a reasonably long product development cycle that all managers have, including us, which involve doing a check on the performance, due diligence on the underlying product, doing a check internally in terms of whether that fits in, where that fits within the product basket, within the local set of products which are available, and it has to go through all these hoops before that product finally, gets filed with SEBI, and of course, it requires then for it to go through those approvals with SEBI regulator itself before we can obviously launch it in the market. So, um, one part of your answer is yes, having a partner helps because you can have very intense discussions about different strategies. You can have a lot of support from their fund managers in understanding how they are running these products and use that information to do a detailed due diligence. But at the same time, it's our duty to make sure that we do that diligence and get the right products. Second point I'll make here is that even if you do have partners, and many of the Indian managers have overseas partners which they do access to, there's no need for us to be limited to those. If there are new strategies, newer ideas which we can tap into, which we need us to go outside those partners, and the individual case can vary from manager to manager depending on the arrangement that they have, but in most cases what we have seen is that it's not a big issue for the Indian manager to then tap into a new idea through another manager if the circumstances do such arise. So I think clearly the onus is on us to make sure that we do a thorough job. And at the back end, we get the best of ideas, best of managers for the Indian audience. It's still very early days. We have relatively few product ideas here, so I think this will be something that as the market evolves and you see more and more launches, you'll start seeing that there'll be room for active and passive, room for multiple managers. I think all of this will start playing out over the next couple of years as this market keeps growing and evolving.
Okay. Sorry, I know I said one last question, but I have one last question, which is that what should be a checklist for investors who are looking at evaluating between various fund of funds? What are the 3 or 5 top things that they should look at?
I think first and the most important thing is understand the nuances of the different markets. Understand where this fund invests in. There is this, we talk about behavioral finance, and there is this availability bias that we have. Just because someone shows us some fund, we start thinking about that fund rather than what is our objective. And I think that's the biggest mistake that we can make. Think about global markets on a standalone basis. Think about, for example, I'll just make a very simple point to make my point that why should all our money go to a US fund? US is a large market, but there are many other markets out there. Now, one of the vagaries or one of the quirks of the Indian market is it's so developed that there are a number of US products in the local market for whatever reason that different AMCs offer. Because these are available, because US markets have done well, a lot of Indian investors have ended up sort of going to US market and seeing that as a global allocation for their portfolio. If you think about it, that doesn't, I mean, honestly, doesn't make sense, right? Because global markets, US is maybe it's a large market, 30-40%, but still there is a 60% out there which is not captured by the US. So think about, more than thinking about the available funds, the most important thing is think about the role that global can play in your portfolio. Think about the horizon, think about the objectives of that. I know it's not easy, but if you can look at some of the key markets out there, US, Europe, the Asian markets like China and Japan, just as, I think little bit of homework. It's not easy, but it's not very difficult either. And we know all the big, stocks which are there, some of the big marquee stocks. We know about some of the big marquee stocks, say in Korea or in China or in Japan or in Europe. These are household names. It gives us a little bit of context. And with that, when we use that background to analyze the funds, we'll be in a far better position to respond to whether a particular strategy works for our portfolio or doesn't work. So my that will be my first point, which is to do a little bit of homework before you actually look at the fund, rather than most people do it the other way around. You get the fund, somebody sends you a fund reference, and then you start working backwards from there. And the second thing that I would say is that there is no greed and versus diversification. I think don't just chase last year's winners. We know the kind of euphoria which is there in pockets in the global markets today. A lot of these fads will find their way into India as well. So we'll find people launching funds on them. We'll find people doing very, very high risk products as well. It's the part and parcel of the market. Money doesn't get made by short term risk taking, aggressive investing. Ultimately, it is slightly boring, I feel. And you have to go back to a more diversified basket, more risk managed basket, more longer term orientation. That's how I think ultimately you will succeed here as well.
Understood. Ashwin, thank you so much for explaining the nuances of fund of funds as a route for investing, and especially since we were talking about overseas investing. So, thanks very much.